If you have over 100,000 saved in a bank, please watch this till the end. My name is Daniel. Last year we got 1.3 million out of banks. Here's why. What if I told you there was a place you could put that money where you could get far more in interest, you could pay no taxes on that money, that's zero, you can access the money whenever you would like to, just like a bank, and you could put the money in a much safer place. There is a place to do this, and it's actually very simple. Before getting to that though, first we need to understand how banks work. And it's actually not very difficult to understand, but banks are functioning not by coming into business with a bunch of money, but they are actually functioning off of the money that you and I put in a bank. So a bank is getting all of their money from everyday people like you and me who give it to them. That's where they are getting the money to go and invest and earn a profit. When they credit us interest, whether it's through a CD, whether it's through a high yield savings account, any sort of savings or checking account, that is because they're taking our money and they're investing it. We're not just putting money in banks and they're just giving us extra money that they're pulling out of nowhere or from charitable donations because they're happy to be able to protect our money for us. That's not what's happening, and I don't think anyone thinks that's what's happening. What's actually happening is they are taking this money and they are investing it, as we said before, but in a number of different places. Now, most of these are actually very accessible to us humans, and one of those places is exactly where we're going to put this money. Before we get there though, we need to understand that when they invest the money, even if they were crediting us some asinine amounts in a high yield savings that is performing well above what the average high yield savings is right now, let's say 4%. If a bank is crediting us 4% interest, that's not because they're earning 4%, but that's because they're earning more than 4%. Generally, if they're giving out 4 in this unorthodox example, it's because they're earning 5% and then they give us the 4%. Now, what if you were able to just cut out the bank and do this yourself? Now, I imagine that for a lot of people, they do understand that they could probably put the money somewhere else and get a higher rate of return, but that's not why you would probably be keeping the $100,000 in a bank. It's because if some sort of emergency comes up or you needed this money quickly, you want to have that on hand. If you wanted to make a purchase or there was some sort of opportunity, you want to have that money on hand to be able to spend it, move it from your savings, wherever it is, into your checking account, make the purchase, and boom, it's taken care of. There's no sort of hassle with wrestling with a financial advisor or something of that sort where it's hard to get to the money, or there's penalties like in 401ks or IRAs, but you just want to have the money liquid. Now, for most of the places that banks invest their money, number one, and we don't generally have access to these, but those are loans, and two is going to be government bonds. Now, these would be more comparable to like CDs, or government bonds, bills, notes, etc., because they are not going to be something where you can just kind of buy and whenever you want you can pull it out and spend it. They are going to be locked up for some time. Second is going to be real estate, or the second one that's accessible to us. But again, same thing with real estate, just not going to be as liquid as a bank account is going to be. And the last one here is actually the strategy that we're going to be talking about today. And that is the place that banks keep their money that they need to spend. We use banks as a solution for keeping cash on hand to spend for emergencies or opportunities or for our daily living. You can imagine banks have expenses as well. They have to pay employees, they have to pay us interest if we're keeping money in an account that is getting interest. So they kind of need to have a bank of sorts as well. This is also the case for many wealthy individuals. For example, Ray Kroc, the founder of McDonald's, J.C. Penney, very famously Walt Disney, uses this strategy. Wells Fargo currently has over $19 billion in this asset. Bank of America has over $24 billion. The entire banking industry, over $200 billion in this asset, because banks need a bank too. And also, it's not just the banks, it's not just the wealthy, it's not just the corporations, but it's also everyday people are realizing they can cut out the middleman, do this, keep the money liquid, keep it safe, make it tax-free, and get higher returns. And that is through what is called, for the banks and corporations, BOLI or COLI. That's bank-owned life insurance or corporate-owned life insurance. You, of course, don't need to be a bank or a corporation to do this. Many of the wealthy and everyday people are also able to do this. They are just the owner as opposed to a bank or a corporation. And they do this for these very four reasons. The money is growing tax-free, it's safe, it's liquid, and it's returning, and it is a bank of sorts if it has all of those features. And that is what is called cash value life insurance. Now, if you're thinking that you don't need any more life insurance, let's go over how cash value life insurance works, because banks, corporations, the wealthy, the everyday people that are doing this, they don't necessarily need any more life insurance either. That's not why they're using this strategy. They're using it for those four reasons. Keep that in mind. So cash value life insurance works by essentially you are putting money into a policy and you are having a very small amount of that money that you put in. So let's say you have a big tower of money here, and this much, this little bottom half here, goes towards the cost of insurance, and the rest of this goes towards a little cash value account. The reason that you put this little bit here towards the insurance and the fees is because when you do that, the rest of this money is also considered insurance, even though it's going to a cash value account. And the reason that it's good that this money is considered insurance is because insurance gets much different tax treatment and is going to get credited interest much different than banks, than a 401k in the stock market, for example. And we'll go over more of those benefits in a second. But the idea is you are putting most of this money towards the cash value, just a little bit towards the insurance. The cash value is continuing to grow. You are able to access the money tax-free. And because this is a life insurance policy, you would probably know if you or a loved one, for example, has been the beneficiary of a life insurance policy, that that money transfers to the beneficiary income tax-free. So since that's the case, not only is your money getting all of these living benefits, like the growing tax-free, the safe, the liquid, and the returning, but also when you pass away, that money is going to transfer to your heirs income tax-free. And since you are putting a little bit towards the death benefit always stays ahead of the cash value. So that money not only transfers tax-free to your heirs, but it's going to blossom a little bit before it transfers. Meaning if over time you had $1 million into a policy, that's what it grew to, all of that was tax-free, you could access it tax-free, and then you die, well, maybe it's going to blossom into 1.2, 1.3 million to your heirs. So that's how it works. You are putting money into a policy, a little bit goes towards the cost of insurance, most of it goes towards the cash value. That money grows with tax benefits and you're able to access it and spend it as you'd like. So since a little bit goes towards the cost of insurance, all of it is considered insurance. Now, why does it work? We mentioned there are many different tax benefits to cash value life insurance, and those are mainly, there's three of them, and that is 7702, 72E, and 101A. Now, 101A, that's the one that says the death benefit, or the money that is going to transfer to your heirs when you pass away, transfers tax-free. So we went over that there. Again, if you know someone, you would know this. 72E and 7702, these two essentially say that money inside of a policy grows tax deferred. So this is actually just like a 401k or an IRA where you're not paying taxes as it grows, but you can also access this money tax-free. There's a couple different ways to do that. First, you can withdraw everything you put in. It's taxed first in, first out, completely tax-free. Since you fund one of these policies with post-tax dollars, if you had over $100,000 in a bank, that money would already be post-tax. This money can be pulled out, even if you already put it into a policy, tax-free. Now, once it grows, then you can access the money still tax-free, even though it's growing tax-deferred, via policy loans. In these, there's a number of different ways to do that, but essentially, you are loaning money from the life insurance company at a certain rate. However, they are going to credit you an interest rate that is equal to, or in many cases, larger than the interest that you are paying. So if you're paying 2% for a loan, the insurance company might credit you 2 or even higher than 2% interest, covering the spread of that loan. A lot of times they'll call these zero wash loans. It's a policy loan, so it still stays tax-free under 72E, and you're not really even paying for it. Why? Because the insurance company credits you the interest to cover that. Sometimes it's even higher. Since these tax codes are in place and most of the money is going towards the cash value portion, as that money continues to grow, which it's going to be crediting you much higher rates than you would get at a bank, you can start to see why this is going to knock the socks off of keeping money, especially a big emergency fund like that in a bank. In terms of how you actually get credited the interest, life insurance companies, just like banks actually, they are not coming into the business with a lot of money. They get their money a little different from banks. In banks, it's because all of us are just putting our money in there to sit so we can access it later. With life insurance companies, well, people do that, and that's exactly what the strategy is, and we're going over now. A lot of the time, they're just getting most of their premiums from people who buy insurance policies. They're paying premiums. They're not really looking to take money out for coverage. Now, they, just as banks do, as I was kind of hinting to there before, invest this money, and with cash value life insurance, just like, for example, that Miracle High Yield Savings Account we mentioned earlier, they credit you, so this is the policyholder, interest. Now, because you get that interest in a life insurance policy, of course, that's going to happen income tax free. So if an insurance company, who generally is going to be much more generous than a bank would be, is earning 5%, they might credit you 4%, and that is completely tax-free, and that's going to continue to compound. You can access that money completely tax-free. There's even other types of cash value life insurance. We won't get into the nuances of them in this video, where you're able to earn 6 and 7% average after all fees, after all taxes, internal rate of return, retroactive back to day one. In terms of returns, obviously they are going to be the better vehicle. Now, we also went in terms of liquidity. Of course, they're going to be the same, where you can be able to access that money whenever you need it. In terms of tax advantages, of course, this strategy is going to win out. And in terms of safety, when it comes to insurance companies, they, even if they wanted to be as risky as banks, aren't allowed to. Now, you probably aren't that concerned with the safety of the $100,000 going into the insurance company, because, well, insurance companies just don't seem to fail like banks do in the Great Depression in 2008. A bank has already gone under this year in 2025. Yes, there is the FDIC insurance. It's a whole nother problem with FDIC. However, how many insurance companies go under in the Great Depression or have insurance policies that aren't paid out because of that, or 2008? Zero. This problem just doesn't exist with insurance companies. So in terms of safety, loan-to-value ratios are much lower. This isn't even really up for debate. In terms of banks would admit this as well. That's why they keep their money in cash value life insurance and not in other banks, because they could do that. Same with the wealthy. So in terms of safety, we have that beat out. And lastly, how do I actually set up a cash value life insurance policy? Now, first and foremost, I need to give a warning. All of this sounds very nice up to this point in the video, but especially if you are using universal life insurance as a means to do this, most of these policies, in fact, indexed universal is one of the most prominent nowadays, 97% of these policies are structured incorrectly. And what I mean by that is, when you have that big chunk of money here, where we wanted just a little bit to go towards the cost of insurance and most to go towards the cash value, the agent or the person structuring the policy, the financial advisor, whoever it is, can structure this policy to where maybe, let's say, this much goes towards the cost of insurance and only this much goes towards the cash value. Well, of course, when much more goes towards the cost of insurance, you'll get way more insurance, but you get way less cash value. And fortunately, conveniently, for the agent or the advisor, that money, this policy, where more of it goes towards the cost of insurance, pays the agent much better. It also gets it to where you and your money isn't going to grow as well, and instead you just end up with much more life insurance. And that very critique that some have, where they say I don't need any more life insurance, actually becomes valid when the policy is structured this way. They can even make it to where this much of the money goes towards the cost of insurance and only this much goes towards the cash value. Now, excuse the terrible drawings here, but the point is, first and foremost, the policy has to be structured where the minimum is going towards the cost of insurance and the maximum is going towards the cash value as defined by the IRS for this money to still be considered life insurance. You cannot move $1 million in and have $1 be considered insurance and the million go towards the cash value and have it still be considered insurance. That's not how this works. There are minimums, TAMRA, TEFRA, DEFRA. These are tax codes that were passed in 82, 84, 88 with Universal Life outlining these limits. There's software that people need access to be able to run these and make sure they're structured properly. And the reason that I pointed out there that 97% of these policies, it's not just like there's a small portion of them that are structured wrong, is because even some of the best financial advisors in the United States simply are good at the whole financial advising thing and putting money in the market, but don't understand insurance. That is why you see people like Dave Ramsey, for example, always critiquing cash value life insurance, but he simply, every time he critiques it, says a bunch of things that are just false. He goes and looks at a red wall and says that it's blue. That is what many financial advisors say when they critique cash value life insurance, and many of them who don't critique it but try and do it themselves just kind of structure it a very textbook way that they were taught, usually not to their own fault, by someone at the insurance agency they joined so that they could sell life insurance to make a little bit of extra money. And the people that teach them generally were taught by people above them, which are people who, this is getting very complicated here, but are people who structure things because they say, hey, you know what, we do need to get paid as well. The more you structure them like this, the more we're going to get paid. They teach the guy under them, they teach the guy under them. They set them up, they think, hey, I can do that whole insurance thing as well. You don't need to go with someone else to do that. They do it wrong. People end up with way less money than they wanted to have. And it doesn't even go into the strategy that we laid out in the video. With that being said, how do you set up a cash value life insurance policy? Of course, you have to go through a life insurance agent the same way you would if you set up a term or a whole life policy. From there, of course, you need to have a set amount that you are planning to move in. You need to qualify, which is much easier than most people think. They think they don't qualify, but they end up being able to. And then from there, that's where the agent is going to take your age and the amount that you're wanting to move in and find out, according to the IRS, how much money they actually can move in, how fast they can move it in, how many years they need to spread that out over, submit the application, and you are underway. If you'd like to learn about this strategy in much greater detail, feel free to subscribe. I release videos 3 times a week. I also do a live stream going into much greater detail. If you have over $100,000 saved in a bank, I really do encourage you to subscribe. Consider this strategy. Again, much higher returns, tax-free returns, safer, and that money is going to be tax-free. Subscribe, and I will see you in a future video.